Hey, how's everybody doing? Back with another dose of economic reality. Thank you for coming back to this channel for another economic slash financial news roundup. All right, let's go ahead and talk about what's going on this week. A big week ahead, and actually, by the end of the week, we're going to be into a new month here. We've got on Tuesday coming up the employment cost index for the first quarter. Not a very popular topic amongst financial news talking heads. But we've got a couple other things. Wednesday, we've got the ADP unemployment for April, auto sales for April, the ISM manufacturing for April. We've got the same, on the same day, we've got the Fed interest rate decision. And of course, everybody expects rates to hold steady, right? Nobody expects rate cuts. Nobody expects a rate hike. They're basically stuck, and we've talked about it here. They're basically trapped, right? They're damned if they do. They're damned if they don't. If they cut rates, they already have inflation that's really causing a lot of problems out there, especially amongst the average U.S. consumer. In our previous reports, our few, one, maybe two or three, within the last two or three, we talked about the consumer is getting more and more behind on their credit cards. The delinquency rates are above 5% now. And actually, maybe I should pull up the numbers on it. And this puts the delinquency rate at the worst since 2012. But yet, they're telling us that the consumer is strong and resilient. Think about that. More than halfway to where we were now in the financial crisis, but yet the consumer is strong and resilient. That's what we're being told. Oh, by the way, another bank failed. I'm sure most of you have heard this. I didn't put this out in my last report. Actually, I didn't think it was big news. I mean, I would have expected a lot more banks to fail by now. I mean, it is a big thing when a bank fails, but when you look at the environment, when you look at the consequences, the result of it, the depositors are not losing their money. The FDIC is going to come and swoop in and rescue these depositors. In fact, they don't even have to do it in this case because another bank is going to absorb all of their assets and all of their loans, everything. So it's going to be just more consolidation. We talked about this. There's going to be more consolidation. And the banks that absorb these failed banks, what we've seen is they start to get in trouble as well. And ultimately, I've said this before, but ultimately, I think it's going to be consolidated down to 10 or less, 10 or fewer mega banks controlling everything, especially when they roll out this digital currency. And that's down the road, that's coming up ahead. But they made the official announcement on the digital currency, by the way, for those of you that didn't see that report. It is official within 12 to 24 months. There's going to be a central bank digital currency. Remember, I started talking about this, was it back in 2019? And people said I was a kook, I was a doom and gloomer, that it'll never happen. Well, now it's officially announced that the digital currency is coming out in 1 to 2 years, right? So just think about it. And just the things I'm telling you, look into them. Don't just listen to me. But if you listen to what I'm saying, if you just wait, usually, it'll come true. Not that I'm the best predictor of what's going to happen, but I've been saying things are going to get a lot worse for a long time. And I had my detractors or opposition, or people with the opposite opinion, saying, no, it's going to crash. You're wrong. And I've been bullish. I've been bullish on the housing market. I've been bullish on the stock market. Later this year, I think we're going to see some big um, drops in the stock market because I think we're going to see a lot of things unfold socially. I think we're going to see social unrest this year. I think we're going to see a lot of other things pop up, so to speak, that are going to really surprise and maybe even shock a lot of people this year. Now, if you believe what the FDIC has said, along with the Fed, they've said basically they're going to back all of the depositors across any bank that may fail, right? So I've kind of taken that off the table as a risk. Yes, I've been keeping my money out of the bank for a while because I know the way the banking system operates right now with no reserves. The banks are leveraged to the hilt, especially when you get into really the deep financial stuff like derivatives. We're talking the big major banks, a lot of them have tens of trillions of dollars in derivative exposure. We talked about that a few times. So the banks are completely insolvent, in my opinion. Yes, there's going to be a bank actually failing every now and then. They want to consolidate the banks, again, my opinion on that. But I think that consolidation is headed towards this digital currency that we're going to see in a couple of years. So all the things that are happening right now, I think they're just going to continue to get worse. they're going to accelerate. Was surprising though to a lot of people that we've only seen one bank failure to date in 2024. But yet by this time last year, I believe we saw two or three just in March of last year. So we're on a slower pace this year of bank failures than we were in 2023. Does it mean that things are getting better? No, I just think that regulators are allowing these banks to go deeper into the red. And it's interesting when you look at just the profits, the banks are still profitable on paper, right? But if you subtract their loan liabilities, then they're not. They're not positive, right? They're deep, deep, deep into the red because they loan out so much more money than they take in deposits. And now that the deposit rates have been dropping, with people, one, losing trust in the banks, and two, people taking their money out of the bank because they have to. They have to pay bills with it. We've got declining savings, yet more and more loans being given out from these banks. So they're more and more leveraged as we go along here. And if you or I did this as a household, we would be bankrupt, right? We can't just go endlessly into the red and not have enough money to make the minimum payments on our bills, on our credit cards, etc. But the banks are a different story. They're allowed to operate in the red, so to speak. I'm not talking about the red as far as profits. You could still show profits, but when you factor in the debt and the loan exposure, these banks are basically insolvent, right? They don't have the cash. And when you look at the cash, it's really not physical cash, anyways. It's digital. Less than 10% of all money in circulation right now is actual physical cash. I'm talking about coins and bills. Not that that's good, but compared to completely digital, um, it's something to look at. Republic Bank had 32 branches. They're going to reopen as Fulton Bank. Republic First Bank depositors can access their funds via checks, ATMs, etc. They operated these branches across New Jersey, New York, and Pennsylvania. Republic Bank had roughly $6 billion in assets and $4 billion in deposits. Notice they don't talk about how many loans they have out, but they're going to absorb this other bank. Fulton Bank is going to absorb their book of loans as well as their customers' deposit accounts, right? So expect to see more of this, more consolidation. I'm not telling anyone to keep your money in the bank or take your money out of the bank. That's going to be up to you. But if you believe what they say they're going to back these depositors, even though the FDIC has, I think, less than 2% of the funds that they need to cover all the deposits that are still in banks total throughout the United States. What they're going to do is just team up with the Fed like they did in 2023. They're just going to create the money out of thin air, and they're going to make the depositors whole again. All right, so big news. I mean, a lot of people have been talking about it, but it's not as big of a deal as some are making out of it. Savings rates pressured as consumer spending outpaces disposable income growth. Folks, we talked about this in our last report, or maybe two reports ago. The savings rate dropped again from February to March. And I can't wait for the April numbers to come out because I think things are about to get worse. The one thing that could help people is some people getting their tax returns. That might be a little bit of a lifeline, but we'll have to see. What are they saying here? This is out of payments.com. The latest personal income expenditures price index from the Bureau of Economic Analysis indicates that the inflation is still very much alive. In March, inflation ran at annualized 2.7% pace, quickening from February's 2.5% rate. Who would have imagined that it would quicken, right? I've only been telling you here it's going to get worse, right? And even the numbers, they're so phony and manipulated and adjusted. What's the word? They're cooking the books. And anyone that still believes the official numbers, I mean, you've got to really take a look at the world, open your eyes to the world, because the official numbers are nowhere near the real numbers. But if you look at the official numbers, it still will show you a trend because they're getting worse as things go along here. Let's talk about Massachusetts, the highest rent in the nation. I was surprised to see this here. Massachusetts has the highest rent in the nation. If you look at the Boston area, the greater Boston area, they're close to $4,000 a month for the median rent. Again, I was surprised. I figured it would be Hawaii or maybe California. But people in Massachusetts, wow. As of March of this year, median rent in Boston, Cambridge, Newton is 3,939 according to a new report released this month here. Overall, the state's median rent is 3,243. Massachusetts rent is the highest in the nation. Wow. So you better like some Red Sox and Celtics if you're going to live and pay those prices there. There's this report out of Axios. The economy needs workers, is what it says. And basically, it sounds like they're trying to justify the millions and millions and tens of millions of migrants coming here, right? Saying that okay, these people help the economy, they're filling jobs um, that are open because we have a lot of jobs that are not being filled. Well, I think a lot of the jobs are not being filled for the most part is because they pay not enough to keep up with the cost of living. Nobody wants to work a back-breaking job just to not even break even, to go further and further and further into debt. So the reason for the job openings is, in my opinion, they're not paying enough, right? People are more incentivized to not work and maybe find a way to collect a check versus working. And then two, if the um, migrants coming here, if they were that helpful to the economy, and think about this, if they were that helpful to the economy, like a lot of these reports are saying, why didn't they help the economy where they came from? Right? Why didn't they help the economy where they came from, whatever country? I think about that. I don't think anyone's even asking that question, but it's pretty simple question, I think, and pretty tells us what's going on. Let's jump into the housing market though, because we see a trend emerging, and I think later this year, I think the fall is going to be a real turning point for the housing market. Right? We're seeing these consumers, so many consumers, getting buried into not just buried into debt. They've been buried into debt for decades, but they're getting to a point where these delinquencies are rising. They're robbing Peter to pay Paul. They're taking money out of their 401k accounts. But take a look at the housing inventory. We're going to see a lot of people, I think, hit the skids in their finances this year and put their house on the market. And if we look at this inventory chart here, going all the way back to 2017, we see that the inventory, the low inventory, which is still low, bottomed out in February, March 2022. But ever since then, we've seen higher highs and higher lows, right? A lot of people were surprised that last fall, October, November, we didn't go much higher than the previous year. It was a little bit higher, but not much. But look where we're at now. We only dipped down to about 665,000 listings, which is usually the low in January. Last year, the low was February, March. It's usually at the beginning of the year is the low. It was 562,000. The year before that, the beginning of 2022, it was 346,000, right? So we're on our way up, and we didn't see much of a dip this last winter, and it's starting to increase already. In fact, it increased from February to March. If you look at previous years, it didn't start increasing until April or May, right? So there's some changes that you really have to pay attention to in the housing market. And I said it's not going to be a crash, and this is not a crash, and it's not an explosion in inventory, but things are shifting, things are changing, and it's actually good that there's not a crash because this gives people more time to prepare. If you're waiting for a better buying opportunity, you may be rewarded. It depends on how much they prop this market up. Remember, no matter how overpriced home prices get, prices don't have to correct. If they change the way the markets work, prices don't have to correct. If they just let the markets flow naturally, then of course we're going to see a crash, but they're not going to let that happen. They're going to come up with more ways to get people into homes. We see all these buyer down payment assistance programs. They'll probably cancel foreclosures again, like they did in 2020. Some people say they won't do that because they don't have the excuse this time, like they did back then with the health crisis. Well, they can find an excuse, believe me. And if they can't find an excuse, they'll make an excuse. And I think a lot of you know exactly what I'm talking about. So keep an eye on the numbers here. Inventory, we're going to keep an eye on it. As soon as it goes higher than where it was at the peaks of last year and the year before, I think more people are going to start talking about it, but it is steadily rising. Something to keep an eye on. Real estate is, mega. It's basically the biggest asset class in the world, from what I read. U.S. real estate. So something to keep an eye on, folks, along with everything we talk about, right? So come back for more news, financial updates here on this channel. Thank you for being subscribed. If you're not, please think about subscribing. And we're going to stay ahead of this financial economic situation together. And we're going to get through this just fine, everybody. Keep stacking. Bye for now. Peace.